Let's now bring in the Wharton School Professor of Finance and WisdomTree Senior Economist, Professor Jeremy Siegel. Professor Siegel, it's great to have you here. What do you make of just the emphatic nature of the market response, both equities and bonds? And, especially, I look at this. I look at the massive breadth. I look at the moves in the cyclical parts of the market and the lower quality stuff. It's almost as if this is early cycle and we've been in, a growth scare or something, as opposed to we've already been at all-time highs. So how do you read it?
Well, first of all, I thought it was very dovish, and I think the market reaction is perfectly right. Listen, small stocks doing so well is textbook. Small companies borrow at the Fed rate, at the Fed funds +1, +2. They are very sensitive to those short-term rates, which now we're going to go down. I wouldn't be surprised to see a 25 basis point in each of the next 3 meetings. Down to the low 3s by the beginning of next year. I think it's appropriate. I've been saying that for quite a while on CNBC, that the short rate should be about 100 basis points below the long rate, and that does put it in the low 3s. And I'm not surprised at the reaction, and I think this means more upside for equities.
I guess the question is, you say you thought that Powell was more dovish than maybe we were led to believe he would be. A lot of folks felt like he would not want to close off various options, right? You have Morgan Stanley, Bank of America. A lot of these big firms do not have a forecast for rate cuts this year, which says to me that there is a relatively robust counter case to the idea that we should be cutting right now. I realize it's at inflection points you're going to get this disagreement. But the idea that Powell is perhaps going to tolerate, cosmetically high headline inflation numbers for the next few months, you think the market can continue to be good with that, even if, let's say, long rates were to leak higher?
Well, first of all, the Fed never forecloses anything for sure. It always does leave that option open. But it's the first time I really heard him say that the tariffs are a one-time increase, and implying that as long as that doesn't spread to other sectors, just, as Steve mentioned, that we should not be looking at that inflation and saying that that's one reason to tighten credit. I've often said, tariffs are like a tax increase. Monetary policy says you should not tighten credit when increased prices is caused by a tax increase. And it seems like pretty much he was on board with that notion. He hasn't seen inflationary expectations go up. My belief is that, the inflation data in the future may not be as important, particularly if it comes from core goods and from tariffs and imports. He'll be looking at the service side of it. And by the way, we know housing is a big part of that service side, and that's been very soft. We see that prices in homes across the country are finally softened to the point of going down, I think, in a majority of states right now. So housing, even though it does get in a lag in the CPI and the PCE deflator, doesn't seem like that big component is going to be a source of that service inflation. So I think that, pretty much that opens the door for those lower rates. And I think that's pretty much the way it should be. And obviously anything can happen, but the market wanted it, and they got it. And it was more clear than I thought he would be, like he was a year ago. The pivot a year ago. We saw a rate. Now, I don't know if it's going to be 50. I think 50 depends pretty much on what the August payrolls are going to be. If we got a negative print, it might be 50. But I think that 25 is certainly in a bag, barring, some sort of crisis we don't foresee at the present time.
Yeah, that seems like the safe assumption. And I guess the other element of why we're seeing this spring-loaded market response, aside from it being a somewhat more clear message about the likely rate cut, is the setup, right? We spent several days with the leadership parts of this market selling off, rotating around, a little bit of perhaps a reason to rethink things like the AI trade and whether, in fact, policy was going to remain as restricted as it is right now. So how do you think the stock market continues to digest this in terms of what parts of the market do better?
Yeah, and by the way, when we got those PMIs from, S&P Global, that surprised on the upside. I think a lot of people said, whoa, Powell does have some ammunition to say things are not falling apart. I'm going to be data dependent. That did not deter him. I think that put a little bit more question. I think coming into the week, we thought, yeah, he's going to pivot, and some of the data actually was not that weak. We do not see the economy falling apart. We don't see crazy strength by any means. I think that Goldman Sachs and others think 1.5% to 2%. I think the Atlanta Fed thinks 2.5% for this third quarter. That's not a runaway economy, and with the supply of labor being restricted so much by immigration and other policies, as Powell mentioned, any diminution in demand is going to result in negative payrolls and rising unemployment.
Yeah.